Yo, what's up, guys? In this video, we're actually going to be going over 5 dividend stocks that you should never sell. And of course, I very carefully selected these dividend stocks for you to never sell them. They got to be really safe. And of course, these ones they're dividend aristocrats, which means they've risen their dividend for over 25 years straight. So even during the 2008 to 2020 pandemic, they've never had to cut their dividend. They were actually growing their dividends through this time. But yeah, I'm also going to be digging into the financials and showing you them so we can actually see how much they're making and how much their dividend cost and how much they're diluting you when actually a lot of these companies are actually buying back their own stock. Anyway, I can't wait to get into it with you guys. Don't forget to drop a like on the video and let's just get straight into it. All right, guys, the first dividend stock on the list that you should never sell is actually Realty Income. They're known as the monthly paying dividend stock. I think they have that trademark too. I don't know. But they actually have a dividend yield of 5.56% right now, and they actually have a surprising amount of room to grow their dividend. I'll show you this right now. So as we can see, they pay 0.257 every single month. So we want to make this on a quarterly basis. So we take the past 3 months and add them up. You get around 78 cents. And let's see how much they make every single quarter. So if their dividend cost them 78 cents, we want them to be making more than 78 cents a quarter. And as you can see, they very much are. They make just over $1 every single quarter, which means they have a dividend payout ratio around 78%, which is very safe, especially for a REIT because they have to pay out these dividends. This isn't like a normal dividend stock because you don't look at EPS. If you did, they would have a dividend payout ratio of way over 200% or something. So you never want to look at that. And let me actually break down the numbers for you. So look, they made $760 million in the most recent quarter. So $760 million, and their dividend from this cost $556 million. So that's another way to look at it. Very safe payout ratio. And they're also a growing REIT. Like, check out their assets. From 1 year ago, they had $49 billion of assets, and now they have $57 billion, staying at that same 42% asset to liability ratio. And this is from Morningstar Research. They have a fair value of $76. And I want to show you what the research says. So I'm not going to read it, but if you're into the stock, I would pause and read this. But this is what the bulls say, and this is what the bears say. But anyway, I'm going to go ahead and take you into the next dividend stock that I think you should never sell. All right, guys, the next dividend stock on the list is Eog Resources, and they're actually trading at a PE ratio of 10 right now. And I'm going to show you why this company is so financially stable. It's actually impressive. It actually impresses me so much. I also own this company, so I might be slightly biased, but they have so much room to raise the dividend, so much so that they even pay out special dividends all the time. At one point, they were basically paying out monthly last year from how much special dividends they were doing, but also they have a rule where 60% of all free cash flow that they make will be returned to the shareholder either through stock buybacks or special dividends. If you noticed, they didn't do any special dividends in the 2 most recent quarters, and I want me to show you why that is. Why I believe it's actually because they just did a ton of stock buybacks, the most they've ever done in actually a very long time. They bought back almost $1 billion worth of their own stock, or $759 million, which is just over 1% of the entire company. They bought back over 1% of the entire company just in the most recent quarter. But anyway, let me show you why they have so much room to organically raise their normal dividend of 2.77%. So this dividend yield does not include the special dividends that they pay. So their normal dividend costs 91 cents. And let's see how much they're making in free cash flow per share. As you can see, it's never been, even close to 91 cents, which is so good. And that's free cash flow. This is their EPS. And what I love to see is it's way above the 2019 level. Look at this. In 2019, they were making well under $2 for sure every single quarter. And now, they're just printing money. So here's how much free cash flow they're making on a bad quarter. Look at this. It was $2.28 billion. So we're going to go off their bad quarter. So $2.28 billion, and their normal dividend actually only cost $525 million. If you're wondering why is it more on these quarters, that's when they were doing these special dividends. Look, they want to return money to the shareholder. That's why if you go to the diluted weighted average shares, you now own 1.7% more of the company than you did from 1 year ago. And most of that's just from the most recent quarter. Look, it went from 184 to 570, or 584 to 577, which is crazy. And I forgot to mention this, total debt of $3.8 billion. And guess how much cash they have? They have $5.29 billion, even after paying out the $800 million special dividend. Anyway, stock buyback. And I wanted to be transparent with you guys. I do actually own this stock. So remember, nothing in this video is financial advice. Everything, just assume, is just my opinion. Everything could be wrong. But I do actually own this one, so I might be biased. But it's in my Mumu portfolio where once I buy a stock in here, I'm never going to sell it for the rest of my life. So if you want to subscribe to my channel and come back in a super long time, I will still own EOG Resources. So yeah, the next stock I actually want to go over is ticker symbol APD. And they actually just reported earnings a couple days ago. And in my opinion, they were outstanding. They were amazing. And I can't wait to share them with you guys. So let's go ahead and get straight into it. This is another one I think that you should just never sell. Well, first, let's just go to their EPS. Look at the year-over-year growth. It's up 30%. That's the number there on the green and the bottom. But if we go to their free cash flow per share, they're up 25% as well. But anyway, let's look at these two numbers compared to their dividend. So their 2.88% dividend cost $1.77 per quarter. And as you can see, that's well covered from EPS. And that's very well covered from their free cash flow as well. All right, so here's the free cash flow. If we take the quarter before this, which was a super bad quarter, $626 million. That's what I like to do. I never give the company the benefit of the doubt. But remember, $600 million and their dividend from this only cost $389 million. So that's what I'm saying. In my opinion, they have a lot of room to grow their dividend. In the diluted weighted average shares, you've actually not been diluted at all as the shareholder. And this is another metric I like to look at. It's the diluted normalized EPS. And as we can see, look at the year-over-year comps. This just goes slightly up every single year, year after year. This is a slow growing, actually, I wouldn't even say slow growing. They're growing 5-6% every single year plus. So yeah, that's why I really like this one. Let me know what you think about this in the comments. You know, if you leave a comment, I'm going to make sure I respond to every single one of them. All right, guys, the fourth dividend stock on the list is actually UNP or Union Pacific. That's one of the railroad stocks to have an incredible moat. You know, there's not going to be any new railroads. You can't really compete with them. It's not an industry people are looking to get into because all the old ones are grandfathered in. But anyway, let's go ahead and look at their dividend stats. So their dividend right now is $1.30, and they don't have a huge history of growing their dividend. As you can see, it's basically been at $1.30 for the past 2 years. But let's check out their EPS. As you can see, it's well above $2 every single quarter. And if we actually go to the free cash flow per share, which is up 15% year over year, of course, it's well above, the $1.30 level. And check out their balance sheet. Their assets to liability ratio was at 80% last year. Now it's at 76%. So that means you own 3% more equity in the company just about, which is really cool. But let me visualize the dividend for you. So in the most recent quarter, they made $2.12 billion in free cash flow. And let's see how much their dividend cost from this. It costs $795 million. So as you can see, they have a lot of room if they wanted to raise their 2.5% dividend yield. And another good thing is you actually have not been diluted as a shareholder. It's basically flat, or you actually own 0.21% more of the company than you did 1 year ago. But they're not really buying back any stock right now. And that's actually because they're retiring a bunch of their debt, or, paying off their debt. And they paid off $662 million in the most recent quarter. So that's probably why I think they're not really doing any stock buybacks in the most recent quarter, because look, they used to do a ton of stock buybacks, but in their most year, it's really weird that they haven't really done any. I think it's because they did they changed the CEO, and then they changed their strategy to pay off debt. Alright guys, the last part of this video I want to dedicate to Starbucks, and it is really sad and unfortunate what happened in the most recent quarter, and I want to be brutally honest. The earnings were like really bad, man. And look at this. The net income was $772 million in the most recent quarter. And if we go to their cash paid dividend, or how much their dividend cost, it costs $645 million. So that really is a higher payout ratio than a lot of investors would have liked. What I think the company probably should do is issue some shares to raise up some cash right now. I don't know, but I want to show you another possible stock that I think you should buy if you also want exposure to this industry. So Starbucks has a dividend yield of just over 3%, but the stock I actually want to recommend, which sounds crazy, is actually McDonald's. They actually had some very solid earnings, and they have tons of room to raise their 2.48% dividend yield. I just feel, in my opinion, it's a lot safer bet. And check this out. Their dividend cost $1.67 every single quarter right now. and their EPS, of course, is well above $2 and sometimes $3 every single quarter, and that's their EPS. Oh, for some reason, it's not showing their most recent quarter of free cash flow per share, but as you can probably bet, it's well above the $1.67. So here's how much McDonald's is making: $2.49 billion in the most recent quarter, which is kind of crazy. And their dividend from this, of course, cost $1.21 million and went up from $1.1 million because they just rose their dividend. So this company has a good history of raising their dividend. But let me show you this. They also have a huge history of buying back their own stock, even though they're at very high and elevated levels. They don't care. They bought back almost $1 billion worth of their own stock in the most recent quarter. All right, so here we are back on the Moomoo app. I want to talk about Starbucks a little bit more. I have some bullish news. So Morningstar Research just updated this yesterday. So they have a fair value target of $105, but there also is some cool data here. We can see how many stores they have. Right now, they're at 38.95 thousand stores, which is the highest amount they've ever had, which is pretty cool. But let me show you what the bulls are saying right now. Of course, you can pause and read this. But I think the company will make it through this. And this is their capital allocation. They have a very sound balance sheet and a manageable debt load with a 5-year forward debt to adjusted EBITDA of just 2. So that's actually very, very safe. Of course, feel free to pause and read any of this. But I just want to say, I hope you guys have a great rest of your day. Don't forget to drop a like on the video if you haven't already. It really would help me out a lot. And subscribe if you're new if you like how I break down all the numbers and also do portfolio updates and all that stuff all the time. But yeah. Oh, hey, buy the dip t-shirt. I hope you guys have a great rest of your day.